Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about what I think is one of the most important topics for trading in general, not just trading options, which is risk and money management. And the reason that I think that most investors think about risk and money management in the wrong perspective is based on the type of questions that I actually get asked a lot. Almost every single week, the type of questions that I get regarding how do I make sure that I have more winners than losers? How do I turn my losers into winners? What strategies can I use to turn my loss into a win? These types of strategies lead me to believe that investors think about lead me to believe that investors think about trading not from a long-term perspective, but in a very short-term perspective. And many times that short-term view, that what you think might be a laser-focused view on winning and profitability, is actually what's causing many times investors to blow up their accounts or risk more than they originally intended to. So today, what I really want to talk about is first, the psychology around trading. Why many times investors are so focused on winning when reality that's really should not be the thing that you should be focused on. You should be thinking about your long-term profitability on your portfolio. More importantly, thinking about risk management, maintaining that the losses in your portfolio are small, because that is really the key to long-term success in trading. So we're going to first talk a little bit about the psychology aspect of it, hopefully shift your thinking in terms of how should you think about trading to give you a different viewpoint. And again, I hope that small realization helps shifts where you focus your attention on. We touched up on this last week for those of you that joined us, talking about managing options positions, where we talked about letting go of small losers and then focusing your attention on winners. Today, we're going to talk a little bit more about the psychology aspect of things. We're also going to talk a little bit about risk management from a math perspective, meaning how do you deploy certain strategies to help you manage risk in your portfolio. So those are the things we're going to go over here today. Now, before I get started, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's go ahead and get started here. Now, one of the things I want to point out here is that for those of you that are brand new to OptionsPlay, you can sign up for everything that we have to offer in terms of resources completely free of charge by going to the link here on your screen at optionsplay.com/TMX. So if you're a first-time viewer here of OptionsPlay, if you're joining us for the first time in terms of education, welcome. There's a wealth of information available to you completely free of charge as a result of the Montreal Exchange. So you can take advantage of all of those things and register for a free account on optionsplay.com/TMX. So today we're going to talk about a few different things, but we're going to start off by talking about trading psychology. This is really how you should think about your portfolio and not think about individual trades, but think about more so your whole portfolio. Every single time you enter a trade and you're thinking about, should I take a loss? Should I take profits? Should I double down? Many times when we're thinking from that perspective, we're thinking too small. We're thinking about our individual trades and we're not focused enough on the big picture. And many times that is what leads us to potentially risk more than we intended to, blow up our accounts potentially. So we're going to talk a little bit about that. Then we'll talk about how to avoid that by starting off by just giving you flat out the rules for risk management. There's one golden rule. It's actually really simple. And what we're going to do is we're going to tell you what that rule is and then work backwards to show you why that rule applies. We're going to talk everything about high watermark. We're going to talk a little bit about the difference between linear versus exponential functions. We're going to talk a little bit about blowing up your account, what that looks like, what does it take to blow up an account, and then talking a little bit about how do you account for consecutive losses so that when you do come across a string of losses, that those string of losses do not blow up your entire account or even a significant portion of your account. Because as you'll learn during the high water mark is that even if you blow up a small chunk of your account, it becomes very difficult to get yourself back to break even. And it becomes increasingly difficult to get yourself back to break even. So it's really important that we do everything we can to avoid blowing up your account by accounting for the fact that we are, at some point in our trading career, we're going to have consecutive losses. And we want to make sure that those consecutive losses do not blow up our account. And lastly, what we'll do is we'll do a bit of question and answer here at the very end to make sure that we answer all of your questions regarding the things that we discuss here today. So before I get started, can everyone please bring up your chat window at the bottom of your screen? And please type yes into the chat window if you can hear me loud and clear. I just want to make sure everyone can hear me. Okay, perfect. I see all yeses. So the question that I want everyone to kind of ask themselves and think about, and what I want to make sure that I am able to show you before you guys leave here today, is making sure that you can answer the question, how could I ensure that my portfolio does not suffer an extreme drawdown or have any type of account blowups? Now, has anyone, been in a scenario where you might have blown up your account because you risked too much of a single trade? Please type 1 into the chat window. If you've ever been in a scenario where you've blown up your account because you got into a trade, maybe the trade went south and you put more money on that trade, and next thing you know, you've lost a significant portion of your account. Okay, I see quite a few ones, right? And everything that we're here to teach you here today is designed to help you avoid that. And some of you may have gotten close. You don't even have to necessarily, in my opinion, get close to blowing up your account. You can even blow up even just half your account, and that becomes a hole that's so large that it's almost impossible to get back from. We'll talk a little bit as to why. Okay, so based on all the times that you guys have said 1, that's why I think this topic is so important. For those of you that have not blown up your accounts, hopefully that this is a teaching moment so that hopefully help you avoid it. But I generally do tend to find that a lot of the lessons that we teach here today, people find it difficult to really learn until they've gone through the process of actually risking a significant portion of their account, unfortunately. But I do hope that for those of you that are starting out, that are new, that you do take this to heart, because as you can see, so many people here on this webinar have blown up at some point their accounts. I'm sure every single one of them never intended for that to happen. So what we really want to talk about are the rules that you can put in place to hopefully help prevent that. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I've been a market strategist for 13 years, and I've worked with retail and institutional clients in Forex and options and futures and equities. And I have seen just about every single possible trading strategy, chart setup, if you will, possibly under the sun. I have seen successful traders. I have seen spectacular blowups. I have seen just about every single type of trading strategy, which is why I feel confident in being able to identify what traits do successful traders have and what traits do unsuccessful traders have, to hopefully help you guys understand how you can shift your behavior to become more successful. Now, I will say, as Ed just said, what's problematic is that there's the academic side and there's the emotional side, and he's absolutely right. And this is really what I'm trying to do, is help you detach yourself from that emotional side of trading. Guess what? The emotional side of trading comes from 2 things. It comes from, number 1, risking too much money to begin with, because when you risk too much, you become emotionally attached to that trade. Number 2, many times the emotional attachment is to winning. It's to being right. But what you realize is that trading has nothing to do with winning, and has nothing to do with being right, because you don't get paid in the long run by winning or being right. What you get paid for is being profitable and not blowing up your account. So that's what we're going to spend most of our time here today understanding and learning a little bit more about. So first, what I want to start off with is just an example, because many of us can relate to this. We are all human, and this is really what causes many of us to be in a scenario where we've lost a lot more than we originally intended on a specific trade. So here's an example of a trade. This is a stock that for a long time used, $26 was a fairly solid support level. So maybe when I approach the support level around 26, you use this as a buying opportunity. So what you do is you buy some stock, it moves up a little bit in the direction that you expected to, but a few days later, it starts to move lower. So you think to yourself, okay, I bought the stock at 26. This is not working out in my favor, but I don't really want to take a loss. And I'll be honest, right? Most beginner traders will, or traders in general, we don't want to take a loss, because that means that we were wrong. That means we're we're down on our accounts. We don't want that, right? Our goal is to win. Our goal is to make money in our account, not lose money. So many times what we do is we do whatever we can to get this trade back to break even, because that means that we didn't lose any money. And in our mind, we think that if we don't lose any money, then I would become a more successful trader as long as I don't lose money. But the reality of trading is that you do have to lose money. There's no way that you can be right all the time. There's just simply no way. And if you intend on trying to do that, that is really what causes many times people to blow up. That's the ironic part about blowing up your account, is it's in the pursuit of not losing that you end up losing all of your account. Because what ends up happening is many times you might find yourself in a position where you bought some stock, the stock goes against you, and you say to yourself, well, I like the stock at 26, and when there was support at 26, well, there's now support also at 22. So if I just buy a little bit more stock at 22, then if the stock rises up to 24, then I'll be able to get out at break even. So even if the stock just moves a little bit higher, I can get myself back to break even. So I'll buy a little bit more. Next thing, what happens? Stock continues to move lower. Now you're saying to yourself, well, okay, the two previous trades didn't work. And at this point, you might be looking at completely different reasons to justify continuing to perhaps risk more money so that you can just get yourself back to break even, because you're thinking to yourself, well, didn't work the first time, didn't work the second time, maybe third time's the charm. So you start looking for other reasons, and you say to yourself, well, okay, this stock has been pretty oversold for quite some time. It's due for a bounce. Let me buy some more. All I need is one bounce higher and I'll be able to get myself back to break even. But guess what? That doesn't happen, and the markets continue to move lower. Now, how many of you can relate to this? Please type 2 into the chat window if you've ever been in a scenario similar to this, where trade goes against you, and you try to find another way to get back to break even by adding more, buying more calls, buying more stock, maybe using some type of repair strategy. And many of you have said that, I learned my lesson a long time ago. I'm no longer doing this. Absolutely. But this is the lesson that many of you that are beginners may not have learned yet, because what you're thinking to yourself is, I'm just trying to get myself back to break even. If I can prevent myself from losing money, then I'll be a better trader. But in reality, what you're actually doing here is doing the exact opposite of what a good trader should be doing, is not being attached to winning, not being attached to being right, because guess what? The market doesn't pay you for winning, and it doesn't pay you for being right. The only thing that matters is that you maintain your trading account so that you can continue trading another day. And this really feeds into the emotional side of us as human beings, of not wanting to lose. But the one thing that I want to teach you here today is that trading has nothing to do with winning or losing. If you focus on winning or losing, then you're focused on the wrong thing, and you're likely going to be very frustrated as a trader for a very, very long time. And in order to understand this, I want to talk about something that really has nothing to do with trading. There was a book written in 1986 called Finite versus Infinite Games by a person named James P. Carse. Now, James P. Carse is not a trader. He's not a financial person. He was a religious philosopher, but he made a very interesting note on how life works effectively. And he said that there's two types of games. There's a finite game and an infinite game. And finite games are games that we're all familiar with. These are rules. These are games with fixed rules. These games end at a certain point, and at the end of the game, there's declared a winner and a loser. Now, a finite game is a game that we're probably all familiar with. It's games like football, basketball, blackjack. These are all examples of what we consider a finite game, meaning these are games that have a discrete goal. You either win or lose based on the rules of the game. And then on the other hand, James realized that there's also a thing called an infinite game. An infinite game is a type of game where there are no agreed upon rules. The game never ends. And what's interesting about an infinite game is there's no such thing as winning or losing. There are either players that continue to have the resources to continue playing and perpetuate the game, or there are players that no longer have the resources or the will to stay in the game, and they simply drop out. So in an infinite game, there's no such thing as winning. There's only staying in the game or dropping out. And what you realize is that when you think about trading, which type of game is it? Yes, each individual trade is what we would consider a finite game. But if you think about your trading career, if you think about trading as a whole, what is it? It's an infinite game. It's not a finite game. And what you realize is that when you, and the important reason, the important reason we're making this distinction is because when you're playing a finite game, you're playing to win. You're following the rules and you're doing everything you can to win, and your goal is to beat the other party in the game. When you're in an infinite game, the thing is that there's no such thing as winning. An example of this is starting a business, right? When you start a business, guess what? When you run a business, there's no such thing as winning in that particular business. You're either in business or you're out of business, and you do everything you can to stay in business. Now, the fantastic thing about this is that this is not some, what's amazing about this is that there's been so many authors and leaders that have now applied this theory to lots of other aspects of our lives beyond just games. You can use it to think about if you think about war, if you think about running a business, if you think about your marriage, these are very, very important concepts that I think are useful, not just in trading, but in your whole life. And I highly recommend at the end, I have actually a video for those of you that are interested in learning a little bit more about this and how this applies to other aspects of your life. I'm happy to share with you some of what I think are the better videos on applying this concept to other aspects of your life. But specifically for trading, this is very, very important because most traders are playing, based on the questions that I get asked from the type of trades that I see people make, what I notice is that people are trading to win. But guess what? There's no such thing as winning when it comes to trading. There's only players that's meaning if you still have a trading account in order to trade, or traders that blow up their account and they drop out. And other examples of this are like the National Football League, right? Guess what? When the National Football League exists, there's no such thing as winning in the National Football League. You can win a football game, but the league itself can never win. The league can either be the dominant league, such as the NFL in this particular case, or you could be the secondary league, for example, the Canadian Football League, which is a significantly smaller league that has significantly smaller revenues, right? But one is not necessarily winning or losing, just that one is bigger than the other. Now, could the Canadian Football League become larger than the National Football League? Absolutely, right? But it's not to say that the National Football League is winning and the Canadian Football League is losing. And that's the same way you should think about your trading account. You could be ahead, you can be behind, but you're never winning or losing. So what you don't want to do is focus on the wrong prize or the wrong game, because when you focus on the wrong game, that's when you have a very frustrating experience, and that's when you don't get the desired outcome. And many times in the pursuit of winning, when you're playing an infinite game, is actually what causes many of us to end up ultimately dropping out, is the pursuit of something that doesn't exist. Because again, there's no such thing as winning in trading. You can either be a trader or blow up your account and you no longer have the resources to continue trading. So I just want to make sure everyone understands this before I move on. If this makes sense to you, please type 3 into the chat window, that there are 2 types of games, and it's very important to identify what game you're playing first before you set your goals for how to succeed in that particular game. Okay, great. I see a lot of 3s. So again, when you're playing a finite game, there's a finite player and a finite player. A finite player playing a finite game, you have a winner or a loss. Now, however, what we tend to see most of the time is a finite player trying to play an infinite game. And what that really leads to is a lot of frustration, because you're trying to win at something that there's simply no winning. And the question that you really have to ask yourself once you realize this is, are you focused on staying in the game, or are you focused on winning? Because if you're focused on winning, guess what? You're going to be frustrated. There's no such thing as winning. But if you focus on staying in the game because you realize you're playing an infinite game, the question becomes, what does staying in the game even mean? How do I make sure that I stay in the game? And this is really where, when you realize that you're playing an infinite game, what you do is you shift your focus from winning to staying in the game. And staying in the game really means protecting your trading account at all costs. Meaning, when you find yourself in a scenario like this, again, what you're not focused on is, how do I make sure that I don't lose, right? How do I make sure that I am right and I get myself back to break even? Instead, your focus is on, well, if I place another trade Am I risking more than I intended to? Am I risking my ability to stay in this game? Because that is really the question you should be asking yourself when you decide to pull this trigger here on the second trade, right? And now, it's very possible that this second trade does not put your trading account at risk, right? It's very possible that, you've traded a very small size on this particular first trade, and you can afford to take that second trade. There's nothing wrong with that. But the question isn't, is this going to get me back to break even, or is this going to make me right? The question is, does this trade put my ability to stay in the game at risk? Maybe the second trade doesn't, but maybe the third trade does. Maybe by the time you get down here, you say to yourself, well, I can't possibly, if I take on this new trade and it goes south, then I'm definitely putting my account at risk of potentially continuing on. And then at that point, you might say to yourself, well, I'm not going to get into this trade. I'm not going to continue adding risk to my portfolio. I'm going to get out. That is the right approach to trading, not how do I get myself back to break even? How do I win? Because in the pursuit of winning, ironically, is really what causes most of us to end up ultimately dropping out of the game by blowing up our account, because we're trying to be right. We're trying to prevent a loss. And that is the ironic part, unfortunately, about trading. But when you realize that when you make this clear delineation between a finite and infinite game, that's really how I see most traders start to advance. So when we talk about advancement, that's an infinite player playing an infinite game. That's the person is only solely focused on advancing. And the only way you can advance in trading is to prevent yourself from blowing up, because you could be the type of trader. You could be right 90% of the time. And all it takes is one trade like this that blows up your account. Guess what? You're no longer in the game. So it doesn't matter that you're right 90% of the time. It doesn't matter even if you're right 99% of the time. If the 1% of the account of the times that you're wrong, you blow up your entire account, game over. So that's why, again, focusing on winning is the wrong thing to focus on. Focusing on how profitable you are in the long run, that is the thing that you want to focus on. And many times that has nothing to do with your win rate. You can win 50% of the time and be a profitable trader if you manage your risk properly. So that's why it's so important for us to have this conversation around risk management. Now, up till now, I've only focused on why we should focus on it. Next, what I really wanted to do, or the bulk of what we're here to discuss, is actually how, right? So first is establishing why you should do it. Now let's talk a little bit about how. Now, the thing about how is that it's actually really easy. It's not difficult at all. And I know many people say it's difficult to learn this. It's a whole nother thing to apply it. You're absolutely right. But the rules for applying is actually really simple. It's not difficult at all. The golden rule of risk management is really simple, is that you never want to risk more than 1 to 2% of your entire portfolio per trade. That's it. And today what we're going to do is we're going to work backwards and show you why 1 to 2% is that magic number, or why that's the golden rule. So if you look at your account value here, and I just have a set of account values here ranging anywhere from $5,000 to $1 million. Now, if you're exceeding in this range, either on the lower bound or the upper bound, you can always make your own calculations. 1 to 2% of whatever your portfolio value is. Now, this is your discretionary portfolio. This is not necessarily including your entire retirement account. So if you have $1 million in your retirement account, but you're only playing with $30,000 in your options account, this only applies to the $30,000 that you're playing with your discretionary account. So what you do is you take your account value. So let's say you have a $50,000 account. If that is the case, then that means every single trade that you make, every single options trade that you make, your max risk on that trade should not be more than $500 to $1,000. So if you're buying a call or a put, that's the amount that you should spend on that call or put. If you're selling options, you also have to factor into what's your max risk on selling that option. So if you're selling your credit spread, you can't just look at how much income you're receiving. You have to look at how much risk are you taking on the back of that income. So it's important that you remember how to calculate this and how you think about risk, but every single time you place a trade, you should have an understanding as what's my max risk, and that max risk must stay within those bounds. This is one of the easiest ways, in my opinion, in the long run to allow you to stay in the game. And today we're going to work our way backwards from the math to help you understand why. Now, to account for what Ed was saying before about the emotional side of things, guess what? it's many times that when we risk a lot of our account, let's say you have a $50,000 account and you risk $10,000 on a single trade. Guess what? That's when we, generally speaking, become emotionally attached to that trade because it's such a significant portion of our account. When that $10,000 trade goes badly, guess what? We know in our back of our minds, we only have $40,000 left, or we've just lost a huge chunk of our account. And that's when we're more likely to take on excessive amounts of risk because you're saying to yourself, I can't really afford to lose this $10,000. I got to do whatever I can to get myself back to break even. And guess what? Many times as the result or the pursuit of that, that's when you put on more risk. And that's really a slippery slope that can prevent you, that can lead you to potentially blowing up your whole account. And that's why staying small many times is the first step in removing the emotional side of things. Because if you're trading a small percentage of your portfolio, you have a $50,000 portfolio, you take a $500 loss or a $700 loss, that's something that you might be able to easily shrug off because you know you still have 98% of your portfolio or 99% of your portfolio intact to get yourself back to break even or place another trade. But when you risk 10% of your account or 20% of your account per trade, that's difficult to do. And I know many people have found themselves in that scenario. So if you've ever placed, or if you still consistently place trades where you're risking more than 1 to 2% of your account per trade, please type 4 into the chat window because I know many investors do. And I know that this is sometimes a difficult thing to do, especially when you have a small account. So if you find yourself in a position where you are still consistently risking more than 2% of your entire account per trade, then I really think it's important that you listen to why we are going to show you this, okay? So staying small, staying in the game at all costs by preventing your account from blowing up is exactly what we're gonna learn here today. So in order to understand some of the things we're gonna teach you here today, it's important to understand the difference between a linear and exponential function. Now, I will say that prior to COVID-19, teaching linear to exponential functions for someone who doesn't like math or someone who generally avoided math class was somewhat of a difficult thing to learn. But ever since COVID-19, people are a lot more aware of kind of how exponential functions work. Exponential functions, by definition, are extremely sneaky or not sneaky, but just very difficult to detect early on. It actually comes off as not moving at all until it becomes a little too late. And that's how exponential functions work, right? Because at first it grows at such a small pace that it's almost completely unnoticeable until it becomes a little too late. And then it grows at an exponential function or exponential pace where it's almost impossible to slow down, like we saw with the COVID-19 virus, right? Initially, most countries said to themselves, well, this doesn't really apply to us. We only have 1, 2, 3 cases. And for a very long time, that just dragged along, 4, 5, 6, 7, nothing to worry about. Next thing you know, you have 100 cases. Next thing you know, 1,000 cases. Then you have 10,000 cases. And it really explodes from there. And exponential functions, and this is really why I think risk management many times is very counterintuitive. The same way exponential functions are counterintuitive, so is many of the rules for risk management. So let's talk a little bit about then the gains required to get yourself back to break even. Because the gains to get yourself back to break even grows at an exponential pace, meaning at first it's not noticeable, and then it gets to a point where it's just completely unmanageable and impossible, if you will, to get yourself back to break even. So this is really one of the things that I want to spend some time on to make sure that everyone really understands why it's so important that we spend the time to learn about this. So when you lose 10% of your account, right? So let's say you have you have 10% loss on a single trade. To get yourself back to break even, you really don't have to do much more than that. You only have about 11% gain to get yourself back to break even. At 20% loss, which is a pretty significant loss to your portfolio, you need about a 25% gain, which is, if you can lose 20%, you can generally gain back 25% without a whole lot more risk. But as you can see, as you further go down the chain here, every 10% more that you lose, it really becomes the growth that it requires to get yourself back to break even grows at an exponential pace. And this is the difficult part, because at 30% loss, you need a 43% return to get yourself back to break even. Up till now, as you can see, the amount is pretty small. I can't even draw much of an arrow here without showing you, the magnitude here. But at 40% loss, You need a 67% return to get yourself back to break even. Think about years that the S&P 500 is down 40%. How long do you typically see that it takes to recover that 40% or the 67% that it requires to get yourself back to break even? Many times it might take 2 to 3 times as long, maybe 4 to 5 times as long to get yourself back to break even. So not only is it difficult, it takes a much longer time. And that's why whenever you're trading in a trading account, yes, you want to certainly avoid anything that looks like this. But I would argue that even anything beyond 20%, anything beyond this line becomes very difficult to get yourself back to break even. So anything beyond 30 to 40%, you're really looking at what is becoming an astronomical hill to climb that's virtually impossible to do unless you deposit more money in your account. So that's why that whenever we're talking about trading, we normally think of trading as avoiding this, but in reality, what you're really avoiding is anything that's greater than this line here, about 25%. Anything portfolio losses greater than 25% become very difficult to recover from unless you deposit more money in your account, which is why everything that we are doing here today is designed to help you understand how to prevent your portfolio from ever exceeding this level. If you find yourself exceeding this level often, guess what? You're going to have a very difficult trading career. If you keep your portfolio on this side of the portfolio, then you're definitely going to find your trading career to be a lot easier. Okay, so does everyone understand why we want to make sure that our portfolio losses stay below roughly 25% of a portfolio loss? This is your entire portfolio. So if that makes sense to you, please type 5 into the chat window. Okay, perfect. I see a lot of 5s. Great. So this is first and foremost, right? Because the gains required to break even grow at an exponential pace, you must do everything you can to keep yourself on the lower end of that curve. The second thing I want to point you to is the number of trades that require to blow up your account also grows at an exponential pace for every 1% less that you risk per trade. So when you risk 10% of your account per trade, you can have 10 trades before your account is blown up by 100%. When you risk 9%, it grows a little bit to 11%. At 8%, it's about 12%. At 7%, it grows little by little. But as you can see, as you go further down the chain, for every 1% less that you risk per trade, guess what? This grows at an exponential pace. So guess what? You want to try to avoid blowing up your account. You can easily do so by making sure that you keep the number of the amount that you risk per trade on the lower end of the spectrum, because at the lower end, what it does is it grows the number of trades that it requires you to blow up your account at an exponential pace. So the goal here is to really make sure that you never risk more than ever 5% of your account per trade, because if you ever risk more than 5% of your account per trade, you're going to find yourself in a position where you've lost more than 25% of your portfolio fairly often. And I say this because just as a general rule of thumb, you know, as traders, you're always going to find yourself in a position where you're going to have a string of losses. Either it's because you have a lot of long positions that are all expiring on the same day, or maybe just the market turns south when you have a lot of long positions. Or just a string of bad luck, if you will, where you thought the market was going to go higher, but it went lower, you reversed lower, and the markets went higher, and the markets just whipsawed you back and forth for a period of time. Regardless of whichever one of these scenarios, I think anyone who's traded long enough has found themselves where they may have a string of losses of maybe 5 to 6 trades. And we'll also talk a little bit about why you want to plan for 5 to 6 consecutive losses. But if you're risking more than 5% of your account per trade, I would say usually at least once a year, you'll find yourself in a position where you might have 5 losing trades in a row. That's going to exceed your 25% threshold that we just established that we want to stay below. So the best way to stay below that is, again, trading small, because at 1 to 2% of your account per trade, you need to have 12 to 25 losing trades in a row before you exceed that 25% threshold. That's a pretty high bar to have 12 to 25 losing trades in a row. So that's why it's so important that you use that 1 to 2% rule. Okay, so everyone understand that? Please type 6 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 6s. So Now that we've talked about 1 to 2% rule, let's talk a little bit about the fact that in reality, when you're trading, you can't just have one win, one loss, one win, one loss. Sometimes you have a string of winners, sometimes you have a string of losses. And we want to make sure that whenever you have those string of losses, that you still maintain the rules that we're talking about and stay within the rules of making sure that you don't risk more than 25% of your account per trade. So what I have up here is a chart of the probability of having certain number of consecutive losses based on your win rate of your strategy. Now, I have the range here of 30 to 70% win rate. I would say most options traders fall somewhere in this particular range of 40 to 60%, but some of us may fall under the extremes of maybe 30, as low as 30, as high as 70. On the lower end, these are options traders that are predominantly buying options. You'll generally find that your win rate is somewhere in the 30, 40% range. For those of you that are predominantly only selling, cover calls, cash secured puts, you might find your win rate to be significantly higher in the 70% range. But the one thing to keep in mind that your win rate and your risk to reward ratio are inversely correlated. So for those that have a 30% win rate, they may have 3 to 1 risk to reward ratio. Every time they win 3 times as much, because whenever you're buying options, you have limited risk, but you have unlimited upside, and vice versa. If you're selling options, you have limited reward and unlimited downside. So the trade-off here is really depending on which one you prefer. Now, I tend to find that most traders are not just buyers or just sellers. They do a hybrid of both. That's why I highlight that most people find their win rate somewhere between 40 to 60%. Now, if your win rate's 40%, the chances of you having 5 consecutive losses in a row is roughly 7%. If your win rate's 60%, you'll find that your win rate, your probability of having 5 consecutive losses goes down to about 1%. But I generally tend to find that most traders will probably average out somewhere around 50%, which means that if you have a 50% win rate, you will have about a 1.5, 3% chance that in a single year where you have 5 or 6 consecutive losses in a row. So I want to take this probability and work backwards to give you a sense for what are the chances of you losing 25% of your account. So if we go back to our risk parameters, right? Where if we risk 2% of our account per trade and we have 5 consecutive losses in a row, what that means is that at a 50% win rate, that means that I have a roughly 3% chance that I will lose at some point in my trading year 10% of my portfolio because of a string of bad luck, because the market's turned around, whatever the reason is. But I have about a 3% chance that I will lose at some point 10% of my account per trade. Now, if you want to account for, let's say, 10 consecutive losses here, right? 10 consecutive losses, that means that I can take a look at this chart here and say that I have roughly about a 0.1% chance of losing roughly 20% of my account per trade, 20% of my portfolio. Does that make sense to everyone? So if I'm risking only 2% of my account per trade, I have a 3% chance of risking 10%, a 0.1% chance of risking 20% of my portfolio, because I would need 10 consecutive losses in a row for that to happen. And you can say to yourself, and you can look back in your trading history just to get a sense for what's your win rate, what's your risk to reward, and that is something that you can factor into this. But the rule of thumb here is to make sure that you plan for at least 5 to 6 consecutive losses in a row, because a 1 to 3% chance is not something that's impossible. 0.1% certainly far more unlikely, but 3% chance, something that probably happens once a year. So this is something that you need to account for, is having at least 5 to 6 consecutive losses at some point in your year, and making sure that when that does happen, you're not exceeding your 25% threshold. In this particular case, I'm only exceeding my 10% threshold, which is okay, because we know that when I lose 10% of my account 10% of my portfolio, I only need an 11% gain to get myself back to break even. And that's why it's so important to utilize this type of strategy in your trading. Okay, so does that make sense, everyone? Please type 7 into the chat window if this makes sense to you. Okay, perfect. So now what I do want to teach you is the fact that sometimes we think about this in a vacuum. We think that, okay, as long as I risk 1 to 2% on my account per trade, I'm set. But there are some caveats to this. And one of the caveats is that whenever we trade options, many times we tend to have what we call concentrated positions. So if you look at your portfolio right now, look at your options portfolio. Do you have multiple trades that all expire on the same day? Many of you may have 5 or 10 positions that expire in June that's just coming up this Friday, right? Guess what? You can't just think about each individual trade as separate entities, because you have to think of them sometimes as concentrated positions, meaning if you have all of your trades that are all going to expire this Friday and they're all long the market, guess what? All it takes is for the markets to turn around this week and all of your trades are likely going to have a very similar outcome. So it's important that you think about how your trades are concentrated, because if they're concentrated, guess what? You can't think of them as separate trades. You actually have to think of them as one large trade. So if you have 5 long trades that are all expiring this week, and maybe each one of them you stuck to the 2% rule, but if you have 5 of them, guess what? That's not really sticking to the 2% rule. That's like really risking 10% of your account per trade, because again, you have 10% of your portfolio that's all concentrated on the same expiration date, on the same, maybe they're all long the market. So again, all it takes is one bad week and all 5 trades will get wiped out. And that's why whenever you're thinking about your trades, you have to think about how well distributed are they. You generally want to try to distribute your trades as well as possible, but if you can't avoid that, you want to make sure that you spread your risk across that specific expiration date too. So when you think about risking only 2% of your account per trade, but you have 2 trades that are all expiring on the same day, and you are accounting for a 5 consecutive loss, what you're basically saying is that you have roughly about a 3% chance of not a 10% portfolio loss, but a 20% portfolio loss, because again, you have 2 trades that all expire on the same expiration date. So you have to factor that into your thinking when you're thinking about your portfolio risk. I'm teaching you this because I know if most of you right now looked at your portfolio, you'll probably find multiple positions that are all long, perhaps even in the same sector, that all expire on the same day. And you just have to make sure that you account for the fact that those get grouped together, that they cannot be considered as separate trades. Now, just to take this an example to an extreme, and I know some of you may find yourself in a similar position where you might say to yourself, yep, I've risked 2% of my account per trade, I'm doing that. But if you have 5 trades that all expire on the same day, so let's say this Friday, you have 5 trades that all expire in June, they're all long, maybe they're all in the banks. Then to count for your 5 consecutive losses, now you, instead of having a 3% chance of a 20% loss, you now have a 3% chance of a 50% loss, because guess what? You have so many concentrated positions that all expire on the same day. So how can you avoid this? You can avoid this one of 2 ways. One, you can spread out your trades a little better so that they don't all expire on the same day. You might want to spread them out across long, short. You can spread them across different sectors. That helps a little bit. But again, if let's say you have I don't know, mostly mining stocks and they're all long and they're all expiring in June and July, then you need to make sure that you account for that. Because if you have a lot of positions that all expire on the same day, then you need to think about the whole, all the positions added up, if those add up to be 2% of your portfolio, or if that adds up to 15% of your portfolio. If it's closer to 15, you should do something about that. You should reduce your exposure, roll out some of those trades, maybe change the sectors of your particular trades. But it's important that you think about your positions, not just from individuals' positions perspective, but from a portfolio perspective. Because again, we're not focused on the finite game of each individual trade winning. We're focused on the broader infinite game, which is your portfolio, and making sure that you keep that portfolio intact. Okay, so this is one of the caveats of planning for consecutive losses, meaning you could actually be exposing yourself substantially more than what you might originally anticipate when you look at each individual trade. Now, there is also some good news, because a stop loss that you place on an options trade can actually reduce your risk, okay? So many times, a lot of the strategies that we talk about, you generally want to have some level of a stop loss on that trade. So if, let's say, you buy an option for $2, you might want to put in a stop loss at $1 so that when the value of the option erodes, you're able to get yourself out. And this is a very important tool in helping you manage your portfolio risk, because if you risk 2% of your account per trade and you have 5 consecutive losses in a row, then you again have in our first slide a 3% chance of losing 10% of your portfolio. But if you have the same trades, 2% of your account per trade, and you're accounting for 5 consecutive losses, but you put a 50% stop loss on your portfolio, now you have a 3.1% chance of only a 5% portfolio loss. So stop losses can be an important tool to help you manage your risk, where maybe you have multiple trades that all expire on the same day, but you've actually halved your risk because you placed a stop loss on that. Now, just keep in mind that stop losses don't always get executed at the price that you want. Stop losses only guarantee execution, not price. So maybe you might find yourself that even though you have the best intentions of having a 50% stop loss, that you actually end up having a stop loss that's closer to maybe 60% by the time everything gets filled. But still, that puts you significantly better than losing 100% of the premium or 100% of the max risk that you have on each individual trade. So these are the small caveats that are important to remember when you're thinking about planning for consecutive losses for your portfolio. When you're distributed in the same long short and they all expire on the same day, that adds to risk. When you place a stop loss on your option strategies, that reduces risk, okay? So everything that we've spoken about so far, I think for the most part is pretty straightforward. Nothing that I've said I think necessarily should be a surprise to everyone, but it is, I think, a good reminder for most people to remember to think about your portfolio across all the positions, not just a single one. But the rule of thumb that we're here to review here again is that what you want to do is you want to, number one, determine what is the amount that you're willing to risk per trade. So again, with a $50,000 portfolio, you want to risk somewhere between $500 to $1,000. And the number of contracts that you can trade is based on the max risk of a strategy. And I just want to show you this real quick on OptionsPlay for those of you that are trading options. Even if you're selling option strategies, so if you're trading a call vertical for a credit. So one of the tools that OptionsPlay actually has built into our tool is a risk and investment calculator. A risk and investment calculator is designed to show you do exactly that. So what you can do is you can utilize the number that you have here, which is, let's say, $500 to $1,000. You can plug that number into the risk and investment calculator. So let's say you have $1,000 to risk, and what we'll do is it will automatically calculate for you the number of contracts, the number of contracts that you can sell or buy to make sure that your max risk stays within that $1,000. So as you can see, all 3 strategies, I can sell 8 contracts of this credit spread. My max risk there is 904. I can buy 2 contracts of these calls. My max risk is 680. And I can buy 3 contracts of the call vertical where my max risk is 948. So it automatically calculates for you the number of contracts that you can trade using this risk and investment calculator, which is the 3rd dot here at the bottom of your screen. So this is all available to you as part of OptionsPlay to help you stay within your means and stick to the rules that we're suggesting here, so that every single time you look at a trade within OptionsPlay, whatever trade that you're looking at, you always use the risk and investment calculator. You plug in your total value that you can risk, and it will automatically calculate for you the number of contracts to trade. And it accounts for the max risk part, not just how much money can you make. It accounts for what is the max risk of each individual strategy when it's calculating that for you. So that's how you can utilize what we just explained here to help you actually implement everything that we just taught you here today. So a quick review before we open this up for Q&A. Like I said, everything that I explained here today, I don't think is difficult to learn. It's actually really easy. The rule is just 1% to 2% of your account. That's it. But in order to really change your mindset and stop thinking about how do I win? How do I get myself back to break even? How do I make sure that I'm right on every single trade? Once you're able to remove your attachment from that winning and you realize that you're playing an infinite game and there's no such thing as winning, there's only players and people who drop out, Then you start focusing your attention not on winning and not on how do I get myself back to break even, but how do I stay in the game? How do I protect my account at all costs? Once you make that psychological shift in how you think about trading, that's when you start thinking about things like, well, how much am I actually risking when I place a trade? How much of my portfolio am I risking when I'm placing that trade? And if a trade goes against me, do I simply cut this off so that I still remain a large percentage of my portfolio intact to make another trade? Or do I deploy more capital to try to get myself back to break even? Again, deploying more capital to get yourself back to break even or getting into another trade in itself is not inherently wrong. There's nothing wrong with that technique. The problem is that most people apply them. Once they do that, they're not only risking 5% of their account, now they're risking 10%. And then by the time they add to it, they might be risking 20%. And that is a recipe for disaster. And that's what we're hoping to avoid here. So to help you keep out of that, by sticking to the 1% to 2% rule and get you into the mindset of thinking about your portfolio as an infinite game as opposed to a finite game, that is the fundamental shift that I see professional traders think through, as opposed to most traders that are, I would say, struggling to trade, think about it in a completely different mindset. So it really comes down to their mindset of thinking, am I playing an infinite game or a finite game? So at all costs, the 1% to 2% rule is designed to help you minimize portfolio drawdown. And you want to always plan for having at least 5 to 6 consecutive losses in a row. Because again, most trading strategies will suffer that once, usually maybe perhaps twice a year. And you want to make sure that when that does happen, you're not blowing up 50% of your account per trade. Now, the best thing and the last thing that I want to make sure that you remember is that you need to think about your portfolio holistically, because again, if you have multiple trades that all expire on the same day and they're all long, you can't think of those as separate trades. They're really just one large trade. So look at your portfolio, think about how your trades are distributed. Are they long, short? Are they across multiple expirations? Are they across multiple sectors? These are things that you can utilize to help you reduce the risk of your portfolio. So with that, I want to thank everyone for taking the time out here this afternoon. This was really, in my opinion, one of the most important topics that I like to talk about as a strategist for investors, because it has nothing to do with strategy, right? We spend most of our time talking about option strategies. We talk about expiration dates, strike prices, all these different things that not everyone necessarily understands, because not everyone's on the same level as far as options experience. But what I just spoke about has nothing to do with options experience. It has nothing to do with how much you know about calls or puts or implied volatility. It really just has to do with your mindset as to how do you approach trading, right? Do you think of it as something that you need to try to win at, or do you think of something that you're trying to improve on and what we call advancing, right? Because if you think about it as an improvement and advancement, that's the right mindset. And the only way to advance is, guess what? Prevent yourself from blowing up your account. But if you think of this game as winning and losing, that's when you'll become frustrated in the long run, because there's no such thing as winning in trading. There just simply isn't. You can win individual trades, but you can't win at trading, and that's what leads to frustration. So that's what I'm hoping I was able to convey to everyone here today, because it's such an important lesson to learn in order to become successful as a trader. So with that, I want to thank everyone for taking the time out here this afternoon. At this point, what I'll do is I'll open this up for Q&A and I'll give you guys, a few minutes here to ask any questions that you might have regarding trading, regarding psychology, or any of the things that are reviewed here today. So please, if you can bring up your Q&A window, there's a chat window and there's a Q&A window. If you don't mind, please type into the Q&A window your questions, so then I will answer your questions out of the Q&A window. So let's go ahead and get started here. Karun is asking for a debit spread and close to expiration date. Is it okay to leave short leg as it is without closing when it's far out of the money? Karun, you can. However, if your goal is just to gain another 10, 20 cents, I will tell you that I don't think that's a good idea, because short legs have unlimited risk when you have a naked short leg. And all you need is just one bad news event, one bad, geopolitical risk. And what you do is you turn your $2, $3 winner into a $30, $40 loser. I mean, is it worth the extra 10 cents? I rarely think so. So that's my view on it. You can certainly do so, and I certainly understand why, but the risk reward, in my opinion, don't pay off in the long run. Ferdinand saying, Tony, love your presentation. My question is, when you have an option that expires in a few months, presently you are up by 100% gain. However, the markets have been up for many trading sessions. However, a correction is expected, and soon the market will drop. So how will you know if it's worthwhile to sell right now and buy the same option? So Ferdinand, the answer is you don't know, right? But there are certain things that you can do to help reduce the risk on that trade. So especially if you're up 100% on a specific trade, what you can do is you can sell half your position and keep and basically reduce the risk on the overall trade down to very little, and then maintain the other half of the position, so that even if the market drops completely, you've reduced your risk, but you still have that other option that still lasts there for another few more weeks or a few more months that can potentially give you more upside if the market continues to move higher. So Ferdinand, this is exactly what we talked about on our session last week. So if you missed that recording, I highly recommend you to go back and watch the recording from last week, because we talked about how to handle positions that are winners, how you can take some risk off the table and maintain upside exposure for the rest of your position. John is asking, if you're correct in your trade and it becomes a large position for you, what's the best way to resize it and keep it within your risk parameters? So if you're correct on your trade, I'm not sure how the position becomes larger, if it goes in your favor, or actually in reality, it doesn't matter whether it goes in your favor or against you. A trade, the risk of a trade is known before you get into a trade, and it doesn't change after you get into that trade. So I'm not sure I really understand in terms of how your risk parameters would change within a trade, but I certainly can tell you that if your account grows by a substantial amount or loses by a certain amount, you want to recalculate how much of your account that you want to risk per trade. But when a trade goes in your favor, the rule of thumb always is to take some partial profits and use those profits to do something else with it. You can either roll that, you can either keep the other remaining half the position, you can change to a new strike, you can change to a new month, but you're all doing it, generally speaking, at a net credit, so that you're reducing your risk and then continuing to play for further exposure in the direction that you expect it to. For stocks, risk to reward is easier. How do we calculate the risk to reward for options trading? You don't have to calculate anything. It's all calculated for you. Every single option strategy you trade, there's a max reward and a max risk. And again, our calculators do the work for you. You don't even have to calculate the max risk. You can just calculate how much you're willing to risk, and we will calculate for you the number of contracts. So here, if you sold this call vertical, you can sell 8 contracts of it, because 8 contracts of it puts a max risk of 904. So everything is done for you. You don't have to do any of this math yourself. That's the benefit of modern day options trading. There's really very little calculation that you really have to do anymore. You know, all you have to do is say, I think the stock is going to go down by 10 points. It will calculate for you your expected return. You can say, I think the stock's going to go up by 10 points. It'll calculate for you your expected loss. It's all done for you. You don't have to do any of these calculations yourself anymore. Kaz is asking, do you have a rule as to what percentage you use to buy stocks? Does the 1 to 2% of your account portfolio rule apply? So Kaz, I will say that I generally find that the rules for stock trading applies the same here, but it generally expands out to be roughly 5% of your account per trade on a stock trade, rather than the 1 to 2% that you might apply to an options trade. What is going to do with optimized cover call and short puts? Siva, I'm not sure what you mean by what is going to do with it. If you don't mind clarifying, I'm happy to answer your question. How does 1 to 2% work out for small accounts like 500 to 1,000? The answer is that it doesn't. And reality is you can't really trade options with $500 to $1,000. It's not that you can place one or a few trades, but all you need is a couple of bad trades and you've blown up your entire account, right? Because you can't really buy something that's $5 to $10 in terms of options. And this is the challenge, I think, for a lot of millennials that are trading in these kind of Robinhood accounts or accounts that allow you to trade with relatively low commissions, is that you're not really trading in the same type of game as traders. You're playing more of a finite game. You're winning and you're losing, that's it. You're not playing for the advancement of your portfolio. If you're playing for the advancement of your portfolio, you would realize that options trading is not the best suited asset class for that. You're better off buying an ETF, holding onto it and growing your wealth and adding to that portfolio every single week, every single month, or every single paycheck to grow your wealth. Options trading is not the type of strategy that would allow you to do that in a $500 to $1,000 trading account. So that might not be the answer you were looking for, but that's the reality. Can you give an example of BCE selling cover calls on OptionsPlay? Sure, that's not quite related to what we were talking about here today, but I'm happy to give you a very quick overview. If, let's say, you own BCE and you want to sell cover calls, you click on the Income tab. The Income tab has income settings, if you will. So my settings for cover calls are short and optimal in terms of time frame and in terms of risk tolerance. Now, by default, that is going to be your settings. If you don't change them, it's short-term optimal. And what this is telling me is for BCE is to sell the July 10th, which expires roughly 25 days from now. It tells me to sell the 59.5 cover calls, which is roughly $3 higher than the current price of the stock. And this generates $27 in income. Now that's the bid price. The midpoint here is $30. So I would collect $30 on a $56 stock. Now, one of the things about this is that BCE does pay a very high dividend already, 7%. 7%. And this cover call pays an annualized return of 7.7%. So even though you have a pretty high dividend yield, this does pay you actually more yield than your dividend yield, which brings your total yield for the year plus the 7% dividend plus a little over 7% in terms of cover calls. You're looking at about a 14% yield. So that's how you use OptionsPlay. You can type in any stock, click on the Income tab, and the Income tab will walk you through a specific expiration date and strike price, how much yield, how much income is it, how much is it in terms of yield perspective. So here TD pays about almost a 5% dividend, but the cover call pays about 10% in terms of yield. So your total yield at the end of the year is roughly 15% on a stock like TD. So I hope that gave you an understanding as to how to sell cover calls using OptionsPlay, Ron. Azim is asking, is this webinar the same as last one on June 8th? No, I would say the beginning is similar because, again, the concept of learning how to play, whether you're playing an infinite or finite game, that is universally applicable to anything related to managing positions or risk management. So that's why they have the same beginning, but the meat of the bones, if you will, was different from last week, Azim. Trevor is saying, very valuable and practical advice. You're very welcome. Is there a way you can share your presentation today? Yeah, so we send out both the recording and the slides to everyone after we finish. John is saying, I usually buy at the money calls or puts, but long dated too, given the time for the trade to work out. It seems that if you buy shorter dated, you can't afford more than one bite at the apple. Thoughts? I think, John, your question is basically saying that if you buy a long-term option, can you risk more of your account per trade? The answer is yes, but not by a whole lot, right? So maybe if you're willing to risk $1,000 on a short-term option, you might risk maybe $2,000 on a leap, but not much more than that. So I hope that answered your question, John. Is there a difference between ratio call put spreads versus ratio back spreads to manage tail risk? A ratio is a back spread. So no, Mike, I don't believe there's a difference between the two. Victor is saying, how do you manage risk on a cover call trades? Well, cover call trades is the only option strategy that doesn't add risk to your portfolio. A cover call and a cash secured put, both of these strategies reduce risk. So a cash secured put is safer than buying the stock outright with a limit price or with a market order. And a cover call is always going to be less risk than just owning the stock without the cover call. So both of these strategies do not require any risk management because they're actually taking on less risk. The only thing is that if you're selling a cash secured put, you need to think about how much cash that you have in your account and whether that stays within your risk parameters for an equity investment. But the short put itself is actually less risk than if you bought the stock outright using a limit order. Ed, thank you so much. I really appreciate that, Ed. Richard saying, hi, Tony. How do you look at implied volatility in terms of risk or decision to buy? It doesn't factor into my decision to buy per se, because if something has a high implied volatility, I can just afford to buy fewer of it. But again, implied volatility has nothing to do with risk per se. It just tells you whether a stock moves a lot or doesn't move a lot. As long as I stay within my risk parameters of 1 to 2% on my account, and I'm comfortable trading something with high implied volatility or low implied volatility, that doesn't factor into my risk tolerance, if you will. Vanu is asking, thanks, well done. What's your best strategy for only put options? Do you limit to 1 to 2% portfolio loss? It doesn't matter what strategy you trade. Puts, calls, buying, selling, 1 to 2% of your account is applicable to all strategies. Raymond, you're very welcome. If I'm down, say, 40 to 50% and already past the 25% loss, is there a point where it's way too late to get out? Should I roll instead? So Ed, if that means that you are in a position right now that's causing you to lose 40 to 50% of your account per trade, to lose more than 40 to 50% of your account, and you're still in that trade and you're thinking about how do I manage that trade, I will say that is a tricky part. I guess it really depends on if this is one big trade that you took, or this was a small trade that kind of snowballed into a larger trade because you added to it. Rolling it just is going to add more risk to it, because rolling means that you're buying something, further dated options, or selling a further dated option that's going to take on more risk. So generally, I don't advocate rolling on a trade that's already losing, because then you're just adding even more risk to the table. So, that really goes against everything that I'm teaching here. Is it better to place larger positions in order to manage the overall 1 to 2% risk, as opposed to spreading the risk out over small positions from a probability perspective? No, I would argue that you're better off spreading your risk across smaller positions than putting all of your eggs in one basket. It's just the law of large numbers. Always spread your risk around. How is OptionsPlay calculating risk on cover calls? Well, again, there is no risk on cover calls. Your risk is always if the stock goes to zero. So $6,145 refers to what happens if you buy the stock right now, sell this cover call, and the stock goes to zero. That's your max risk. Azim, you're very welcome. Jay Green, is it better to place, I think I just answered your question here. No, it's 40 to 50% of the trade itself, not the portfolio. Oh, Ed, so if you're down 40 to 50% of the trade itself, then rolling it very well might be a suitable strategy. Sorry, if it was 40 to 50% of your portfolio, I would definitely not recommend rolling it. But if it's only 40 to 50% of the trade, and the trade itself originally stuck to the 1 to 2% rule, there's nothing wrong with rolling that trade. But I will say, if the trade has gone against you, right? So if you find yourself in this position, effectively, I think what you're telling me is that you are in this position. You bought the trade initially, the trade has gone against you a little bit. It's gone 40 to 50% of the initial trade, right? And you're asking yourself, should I roll it to hopefully wait for this stock to recover? The answer is, if you weren't already in a losing trade, right? If you weren't in this losing trade, would you buy this stock here? Would you try to shoot for this stock to go from 22 to 26? If the answer is no, then you should not roll your position. If the answer is yes, then I would advocate that you simply cut your losses from the first trade and then enter the second trade separately. Remove yourself emotionally from that first losing trade. Once you've removed yourself emotionally, then ask yourself, would I place another trade right now shooting for this stock to rally up to 26? Pretend that first trade never happened, because for all intents and purposes for the second trade, the first trade doesn't matter. It doesn't matter whether you won or lost on that last trade. The only thing that matters now is what trade you make going forward. So ask yourself, would you, when you think about rolling it, right? Would you buy that next month option if you weren't already in a losing trade? 9 out of 10 times I find the answer to that question is no. Most people will say, no, I will not place this trade if I wasn't already in that losing trade. So if that's the case, let go of that losing trade and move on. Don't roll it. That's the best way to view that, in my opinion. Dean, I will make sure that we include the slides to the presentations after we finish here today. Example, an account size of 100,000, risk is 2% of the account, so that's 2,000 on a trade. But if you put a stop loss at 50%, isn't the risk just 1%? So if my rules say 2%, but I'm willing to risk trade not be 4%, $4,000. So, I mean, the thing about the stop loss rule is that stop losses are almost like a wish, right? You're basically saying, I wish to get out, but it doesn't mean that you're going to get out. So, and you know, the thing that many traders tend to have, and I know this because I'm guilty of it myself, is that you have a stop loss and the trade gets close to your stop loss, and guess what? You move your stop loss because you think to yourself, it's so close to turning around. It's gone against me, but it's going to turn around. So I'm going to move my stop loss. So next thing you know, you originally intended to have a 50% stop loss. Next thing you know, you have a 75% stop loss. And then by the time the 75% stop loss gets executed, you're already down 85%. So yes, you can try to play around with my rules and say, well, then I'll just risk 4% and then I'll put on a 50% stop loss. But we all know that emotionally that doesn't quite work that way. It certainly doesn't work that way mechanically when you place a stop loss. So you can play around with the rules, but again, understand that what you're putting at risk to do so. Wallace is asking, you are always amazing in both US and Canada webinars. Do you think it's time to set up some downside protection, such as long put on broad TSX ETF? So for those of you that join us for our market outlook sessions on Tuesday mornings, TSX certainly doesn't look as strong as the US markets. TSX is still below this, what I would consider this major gap level at 24. You know, I do think that, you know, you had this fill at the gap here, so, and it bounced lower here, which isn't particularly constructive. I am concerned about a potential pullback here in TSX, but I will say that I don't think that it's a bad idea to put on a hedge here for TSX because the Canadian markets does look weaker than the US markets here. That's just a very quick view of the TSX charts right now. How do I join the Tuesday morning market session? So again, that's only for the US side. So this is only for if you're trading US, but the link to join is trade.optionsplay.com/weekly, which I will post into the chat window. If you go to that link that I just posted in the chat window, you can sign up for our Tuesday morning session. Ash is saying, I want to generate consistent income because my account is so small, I don't have room for anything else. I plan to sell cash secured puts until it get a sign and then write cover calls until it gets called away. Then I will continue this process. This is a safe strategy given that SPY will be most of my entire account. Absolutely, Ash, this is what I've been teaching for a very long time for equity investors, is that you don't have to trade options to speculate. You could just be someone who wants to buy an ETF like XIU or a stock or SPY. You can do it just by selling puts to get into the stock and then selling cover calls when it rallies, and do the same thing over and over again. Puts allow you to buy low, cover calls allow you to sell high. If you're able to do that consistently over a long period of time, that's how you're going to be able to generate income and invest in this particular market. So Ash, you're spot on with your question. Kevin is saying, if I sold a cover call and in the contract to let the stock go if it goes up, can I still sell the stock if it goes down, or is the stock basically on hold because of the contract? Kevin, you're never on hold at all when you sell a cover call. You just have to buy back the call and then you can sell the stock. So if the stock plummets, you should be able to buy back that call for next to nothing. So you actually make a profit on that cover call and you're able to sell your stock. You just have to make sure that you buy back the call first before you sell the stock. That's it. But there's nothing that holds you to the contract just because you sold a cover call. Eric Cott, thank you so much. Thank you for joining us. Where can I access part 1 advanced recording? So you can go to our OptionsPlay Canada YouTube channel, which I will post a link to everyone here. We actually have a playlist specifically for the advanced trading courses. So I just sent everyone a link to the OptionsPlay Canada website. We have the Advanced Options Master course here at the bottom that was updated 7 days ago. That was the link to the first webinar, so you can access it there, Liliana. And Steve is asking, oddly enough, cash secured puts require level 4 options capability. Most options positions start at level 2. Any comment about that? Unfortunately, if I could change this, I would make cash secured puts a level 1. I really don't understand why, if they allow you to invest in stocks, why they wouldn't allow you to sell a cash secured put, because a cash secured put, again, is less risk than buying the stock using a limit order. But again, I unfortunately cannot influence that at the present moment. If I could, I certainly would. So unfortunately, Steve, you're going to have to try to get that level 4 clearance. Again, for most investors that are sophisticated and have a portfolio of size to buy 100 shares of the stock, usually you're able to get that. You might have to make a couple of phone calls in order to do that, but that's what I have found. So with that, that covers all of the questions that I have provided here, that you guys have submitted here. What I do want to leave you with is a fantastic speech by Simon Sinek on the concept of this infinite versus finite game, on things that are not applicable to trading, but just life. And I think it's a great 30-minute view, 25-minute view for those of you that are interested in learning a little bit more about this topic. It is so important to trading. It is so important to just the way that you view life, in my opinion. So I'll leave everyone with this recording, which I just posted into the chat window. If you have the time, I highly recommend it. He's a fantastic speaker. Even if you learn, even if you pick up on some of his other shorter videos, I think you can pick up some great things regarding leadership, regarding running a business. For those of you that run your own business, or maybe you are a manager and you lead other people, especially in these times, I think it's a great thing to learn a little bit more about, and I think it's beneficial for traders as well. So with that, I want to thank everyone for taking the time out here this afternoon. I really hope that you guys find this useful and helping you better understand how to manage risk in your portfolio, how to prevent those account blowups, and focus on the right thing, because you're playing in an infinite game, not a finite game. Focus on the long run, focus on advancement, focus on not blowing up your account, and that's how you become a much more successful trader. So with that, thank you so much. I hope you guys have a great evening. I will send out the recording with the slides in about 30 minutes after I finish here today. So have a great night, and I'll see you guys here next week.